We're going to take this segment and talk about interest rates and owner financing and how they work together and how owner financing can help you generate much higher rates and returns on your investment than other investment vehicles. Let me just briefly talk about what owner financing is and why we like it. So I believe that owner financing is one of the greatest wealth generators that is out there. Now, many of us understand what a rental property is. Well, if you're going to go buy a rent property, you've got to have either cash or money to put down to go get a loan if you're able to do so. Now, if you're going to buy a home for seller financing, you have to go through the same mechanisms. The difference is when you sell a home with owner financing, you get a down payment, and that down payment will allow you to buy 1.5 more houses for owner financing than you could for rental properties. It's really a 2 to 3 ratio. For every 2 rent properties you can buy with the same amount of cash, you can buy 3 seller finance properties. Now guys, I kind of like 3 better than 2 because it helps me get to my end game quicker. So simply put, if you've got 3 properties, you're going to generate more cash flow than you would with the other 2 properties when you're dealing with like-kind transactions. Owner financing is where the seller is the bank. They become the lender to the borrower. And it doesn't matter whether the seller has no debt on their property or they have debt of some format out there. Either way works just fine. So if you're interested in learning a little bit more about owner financing in this topic, take a moment and click on the link above. So let's just talk about interest rates for a minute. There's always a cost to money. If you intend to use all cash to buy a piece of property with, that's great. You won't have an interest rate on that property. But what you lost is you lost the ability to invest that cash into another vehicle, and ergo you're losing interest. So there still is a direct relation between paying cash for a home and investing capital. Now, there's always a cost to money, and of course, the more our cost of money, whatever that might be, means the less we can actually purchase the same piece of property for today versus tomorrow. Now, let's talk a minute about mortgage rates and institutional bank rates. 12 months ago, mortgage rates for the investor marketplace were hovering somewhere around on the low to mid 5s up to maybe 7%. Today, those mortgage rates are even higher. They're somewhere around the 8% plus range. In the banking world, banking rates for investors were somewhere around the low to mid 5s, and today they're in the mid upper 8s and even the low 9% rate. And so with those added increases in interest rates simply means that our cost of money today is more, meaning we can buy less with it. So we either need more money so we can buy the same property, or we have to negotiate the price of that property down lower. And of course, that's the hard part. So let's just take a minute and talk about interest rates and owner financing and how owner financing does help us to compensate sometimes for these higher interest rates that are out there. Now, when we're selling a home using an owner finance vehicle, it is almost always the case where we can get a substantially higher interest rate than you can through other mechanisms. So why is that? Well, think about this for a minute. When we're selling a home using a seller finance model, remember that about 80% of the population cannot qualify for a traditional mortgage. So simply put, if they want to buy a home, they can't qualify for a loan, unfortunately, they become nothing more than a glorified tenant in that regard. In that instance, if they still want to buy a house, then they're going to pay a little bit more for the opportunity to do that. And remember, when we're selling a home using seller financing, we're really selling an opportunity because that borrower cannot go out and buy a home through traditional mechanisms. But we're also selling a reasonable down payment and a reasonable monthly payment that is associated with that property in that particular neighborhood, and again, in that particular market as well. So oftentimes our owner finance buyers are willing to pay higher interest rates to be able to buy the house because they want to own the home versus lease it. Next, we try to teach the buyer that when they're buying that house, they're going to get a tax write-off. Of course, you don't get that on a rental property someplace. But if you can demonstrate how a tax write-off really helps to lower their overall monthly payment, even though it may be a little bit higher than what they would be renting for, it really helps to compensate the transaction and to encourage the buyer to move forward with the transaction. Again, buyers will pay more because maybe they have some credit issues, maybe they have citizenship issues, other risk factors that may be out there that don't allow them to get traditional mortgages, or maybe they just don't want to deal with a mortgage company or a bank. And we see a lot of that in the industry, and I understand it very well. So our sellers want a higher interest rate because they're having to do more work as well. They're taking more risk because they're not getting all their cash. They're financing the transaction. There may be risk factors with the buyer, as we discussed. They have to deal with the monthly payment. They have to receive the payment, maybe collect the payment. They have to maybe pay an underlying mortgage. They have to deal with taxes and insurance and the escrow associated with the property and things of this nature. And of course, to do that, they're going to simply want a higher return on their investment. So let's just take a minute and look at a basic owner finance transaction. So let's say that you have a property that has an after repaired value, we call that an ARV, of $200,000. Simply put, that's what the house will appraise for today. In the seller finance world, we're able to typically sell our homes for a premium, and we can do that for many reasons. A, there's no mortgage company involved, meaning the buyer is not paying mortgage fees that can be applied to the higher down payment. They're going to have lower closing costs. Again, those can get applied to the down payment. And of course, again, remember, we're selling an opportunity, a reasonable down payment, and a reasonable monthly payment. So let's say in this case, we sell our home for $220,000, which is a 10% markup. That leaves us with a mortgage of $200,000 on the property. So in the owner finance world, you may very easily be able to sell that at a 10% interest rate. If you've never done it before, you go, wow, that sounds high. And it is high to the traditional mortgage world, which right now is around 7% or so. But if the buyer wants to own a home, they're going to have to step up and pay a little bit more for that opportunity. So if our buyer has a $200,000 loan at a 10% interest rate, let's say for 30 years, they have about a $1,750 a month principal and interest payment. We're not going to talk about taxes and insurance, as that's totally separate. So let's assume you sell that same house for a 6% interest rate instead of a 10% rate. The borrower is going to have about a $1,200 a month payment. Guys, that's a big difference. That's almost $550 a month different cash flow. Don't know about you, but more is better. And so I would much rather be able to collect that additional $550 a month on my property versus the lower interest rate. And that's really how our investment world works. If they can go to a big box bank and get a mortgage on their property where they might have a 7% interest rate mortgage, okay, great. They're going to have about a $1,300 a month payment. Well, if they can't do that, they're stuck, and therefore they have to go with owner financing, and we as the seller deserve to earn more money. And so in those cases, we're going to make a much larger profit than we would if the buyer was going through a traditional mortgage. And even if you lease the property, I'm going to tell you that we're making at least a 10% higher return on our investment than we are through the rental scenario as well. So a lot of people will say, well, I want to rent my property because I want to own it and eventually pay it off. I get that. There's nothing wrong with that. And there's a different philosophy out there for rental properties versus seller finance properties. One thing I look at is this. If you take apples to apples and you rent your house out over the course of 30 years and pay off your debt, you own the property debt-free. You get depreciation And of course, you get the privilege to recapture that depreciation whenever you sell the property. I get those arguments. With a seller finance modeling, you also pay off your debt over the same 30 years. But now I might have 2 rental properties debt-free, but now I've got 3 owner finance properties that I had debt-free because I paid my debt off faster with that additional cash flow I get. So I get a chance to generate all this additional debt-free cash flow over the years. Now the difference between the leasing modeling and the seller finance modeling is simply this. With a rental model, the average resident stays in a property for about 2 years. When they vacate, you have downtime, meaning lost revenue. You have to go back in, clean the property back up. You have leasing commissions, and you may have management fees where you want a third party to manage your property for you. Whereas on the seller finance modeling, you don't have any of that. If you have repair issues that pop up on your rental property, whether it's the HVAC, roof issues, a leaky commode, whatever it might be, you get the privilege of paying for that out of your pocket. Whereas with the seller finance modeling, it becomes the borrower's responsibility. It is my conclusion in all of this that over the course of time, when you look at apples to apples, a rental property versus a seller finance property, the additional cash flow, less expenses incurred with owner financing versus that with rental properties, that they're going to break even over 30 years. And it simply comes down to the path of least resistance at that point in time. And when you consider those kind of things, what I've considered is the seller finance modeling is the best. Now, with all those said and done, charging our borrower this 10% rate is great. You can actually charge more, but you need to make sure you understand what the rules and regulations are surrounding interest rates when you're doing seller financing. There are some things that do affect us. There's the SAFE Act, the Dodd-Frank Act, and items of this nature that you need to consider when doing so and understand what your parameters are as you're setting your rates and your terms for your sale of your property. So you're working with your buyer and negotiating your sale. It's pretty easy to explain why your sales price is a little bit higher. We discussed that earlier. It's easy to ask for a reasonable down payment. You know, most down payments right now are about 5%. If it's a jumbo loan, it's a much higher rate, of course. So if you're asking, let's say, a 10% down payment, it's not a big jump when you consider a 5% down payment plus the savings you get from mortgage companies and title company reductions in cost and fees and things of that nature out there. But how do you really talk about the interest rate and those items and that monthly payment? Typically, I don't talk about the interest rate. I just talk about the monthly payment, and to ensure that they can afford that payment. That's really the most important thing, is that they have the ability to afford the loan. They have the ability to repay the loan that is out there. And when you understand that 80% of the population, as I said earlier, cannot qualify for a traditional mortgage, it is awful easy to tell buyers who start wanting to negotiate your transaction that you've got a stable of buyers behind you ready to buy this property at that price. Because now you're dealing with 80% of the population who want to be able to buy the house versus maybe that 20% who can go the traditional mortgage route. And so it really makes the negotiations pretty easy and pretty straightforward. So guys, just a quick recap. Owner financing is an awesome mechanism for generating wealth. It is worth learning the ins and outs of seller financing all day long if you're interested in generating long-term generational wealth. In addition, remember, we're dealing with 80% of the population who can't qualify for traditional mortgages. The demand is always there. In addition, I like the old adage, more is better. We're getting a much higher interest rate, meaning we're making a much higher cash flow over traditional interest rates as well as over standard rental rates as well. So let me just encourage you to take the time, check us out at theownerfinancenetwork.com, where you have a lot of information you can learn about seller financing and how it can help benefit you in your investment career. So guys, don't forget to like, comment, and subscribe, and we'll see you guys next time.